Welcome to the Explainer. So, if you follow the markets, you're totally used to seeing your portfolio twitch and reprice every few seconds, right? Now, you and I both know no new factories are magically being built in those 60 seconds. So, what exactly is driving that constant recalibration? Today, we're diving deep into the real machinery behind those daily wiggles, with a special focus on how raw sentiment drives the action. By the end of this, the madness of the market won't seem so mysterious anymore. Okay, let's dive into this. I want you to imagine opening your trading app right now. You see a green arrow, then a red arrow, then a green one again. What actually nudges that price up or down at, say, 11:15 on a random Tuesday morning? There's no bell ringing, no massive announcement. The honest answer is actually way simpler and honestly maybe a little stranger than most people expect. It's incredibly easy to imagine that somewhere out there, there's this grand machine, like some omniscient supercomputer acting as a financial referee, calculating the exact objective worth of a company every single second based on some massive algorithm. But spoiler alert, that machine doesn't exist. A share price is not handed down from above. Instead, it's discovered live by a massive crowd. It is, quite literally, just a live vote with money, where buyers and sellers meet on an exchange. Basically, every single thing you will ever read about stock prices is, at its absolute core, just a story about why this balance of buyers and sellers tipped one way or the other. Section 1. The mechanics, supply and demand. To really understand this crowd, we have to start with the raw mechanics of the exchange itself. Whether you're trading on the NSE or the BSE, every single order placed into the system carries a specific limit. If you're a buyer, you post a bid, and that's the absolute highest price you are willing to pay. If you're a seller, you post an ask, the absolute lowest price you are willing to accept. So, the exchange's computers take all of these bids and asks and continuously try to match them up. A trade only happens when a bid and an ask finally agree. The exact moment they do, that transaction goes through, and the price of that exact last matched trade instantly becomes the new quoted price on your app. And this brilliantly illustrates a core truth. If you see a stock ticking up all afternoon, it doesn't mean the company inherently became more valuable. It simply means the buyers in the crowd kept raising their hands and their bids faster than the sellers. Section 2. The long run. Guessing the future. When we zoom out from that minute-by-minute matching engine, this massive voting crowd is basically trying to guess one fundamental thing. How much actual cash is this business going to generate in the future? This is exactly why quarterly results matter so much. In India, SEBI requires listed companies to file their results within 45 days of a quarter's end. This creates a huge wave of fresh, hard numbers that constantly reset the crowd's expectations. But it's not just the companies themselves. Macro factors play a massive role too. Take the RBI's repo rate, for example. When interest rates change, it completely shifts how attractive safe options like fixed deposits look compared to riskier shares. This quietly but powerfully shifts the underlying demand across the entire market. Section 3. The twist. Expectations versus reality. Now, here is where we pivot to the psychological twist that trips up even seasoned traders. Let's look at what happens when expectations meet reality. Imagine it's earnings day for a really popular company. Based on all the hype, the news, and the forecasts, the entire crowd of buyers and sellers expects this company's profits to grow by a massive 20%. The buyers are so confident, they're happily paying top dollar today just to get in on that 20% growth. Then, the numbers are officially released. The company reports 15% growth. Now, objectively speaking, 15% growth is fantastic. It's a genuinely good, solid performance by the underlying business. But what happens to the stock price on your app? It falls like an absolute rock the moment the numbers hit. So the crucial point is this. It is the surprise that moves the price, not the news itself. The buyers who already paid a premium expecting 20% now feel overcharged. The market had already baked in a bigger jump. You can have the exact same earnings report cause a completely opposite reaction in the stock price, entirely depending on what the crowd expected beforehand. Section 4. Sentiment, the mood of the crowd. Beyond the mechanics and beyond even the fundamental data, the single most powerful driver of daily stock prices is plain, raw human emotion, sentiment. The legendary economist Benjamin Graham perfectly captured this with his famous character, Mr. Market. He said to imagine you have a business partner who shows up every single day offering to buy your share or sell you his. But this partner, he's deeply emotional. Some days he's totally euphoric and offers you insanely high prices. Other days he's in total despair and will sell to you for pennies. He is rarely calm.
And why does this happen? Well, because human beings absolutely hate uncertainty. When the future is unclear, logic takes a backseat to herd mentality. In the short run, fear and greed move prices much faster and much harder than any financial spreadsheet ever could.
Section 5. A real-world swing, July 2026. To see this behavioral theory play out in real time, think back to the middle of July 2026. It's a really tangible example from the Indian markets. On July 10th, the Nifty 50 jumped a brisk 244 points in a single trading session, closing around 24,207. Meanwhile, the Sensex was hovering near that massive 77,500 to 78,000 zone. It was a huge, completely green day across the board. But I want you to step back and think logically for a second. Did all 50 companies in the Nifty, representing drastically different industries, all suddenly get 1% more fundamentally valuable overnight? Did they all magically invent a new product or double their sales in 24 hours? No way. Of course not. On days like that, when the underlying companies do absolutely nothing new, the index lurches purely because of sentiment. It was the crowd's collective mood shifting. Maybe there was a macro signal that was better than feared, or just a spark of returning confidence. Whatever the actual trigger was, buyers across the country succumbed to the fear of missing out and decided, all at once, that shares were suddenly worth reaching for. Sentiment just sloshed heavily to one side of the boat. Section 6. Finding signal in noise. So how do you actually separate the meaningful signal from the noise? Well, you have to frame your entire approach around two vastly different timelines. The long-run price is trying to answer, what is this company actually worth over the years? That line follows real earnings. But the short-run price, that's just answering, what is the crowd feeling today? That line follows pure emotion and sentiment. Now, what's really interesting about these two concepts is that confusing them is exactly how beginners get whipsawed. They end up buying high when the crowd is euphoric and excited, and selling low when the crowd is gripped by fear. Let's rapidly lock in the core lessons here so you can keep them in mind the next time you open your app. 1. A price is literally just the last agreed trade between a buyer and seller, nothing more. 2. In the long run, prices track a company's real future earnings. 3. In the short run, they track raw sentiment and the mood of the crowd. And 4. It is the surprise that moves prices, not just the news itself, which is exactly why seemingly great results can still cause a stock to drop. I'll leave you with this thought. The next time a stock you follow makes a massive one-day leap, I want you to pause before you react. Ask yourself, was that a fundamental shift in the business? Was it a genuine earnings surprise, or was it just Mr. Market having another one of his euphoric mood swings? Building the habit of asking that question is for sure the first step to truly mastering the market. We'll be exploring how a company's market capitalization acts as an anchor on these wild mood swings next time. But until then, keep a really close eye on the crowd.